All right, let's talk about something really important, a key piece of your financial puzzle that honestly gets ignored way too often. We're going to dive into how to protect what is almost certainly your most valuable asset. So let me just ask you that straight up. What is your most valuable asset? Seriously, take a second. What's the first thing that pops into your head? So what you think of? Your house? Your car? Maybe your 401k? Yeah, those are the usual suspects. But what about the one thing that pays for all of it? We're talking about your ability to get up every day and earn an income. And that is exactly what we're digging into first. We've got to talk about how we ensure this asset, because there's this huge blind spot in the way most of us think about financial protection. I mean, think about it. It's kind of crazy, right? We would never, ever dream of not insuring our house or our car, but that thing that pays the mortgage and the car payment, our income. So many people just leave it totally exposed. If something happens and you can't work, how does everything else get paid for? Well, this blind spot leads to what you could call a disability gap, a massive disconnect between what we think our risk is and what it actually is. Let's just look at the raw numbers here. A study found that a whopping 64% of wage earners think they have a 2% chance or less of being disabled for a long period of time during their working years. Sounds pretty unlikely, doesn't it? But here's the reality check. And this number, well, it's a big one. According to the Social Security Administration, more than 25%, that's 1 in 4 of today's 20-year-olds, will become disabled at some point before they retire. 1 in 4. Suddenly, that doesn't feel so remote anymore, does it? And that, right there, is the exact risk that disability insurance is built for. It's your financial safety net. It kicks in to replace a big chunk of your paycheck, usually somewhere between 65 and 75%, so you can keep the lights on and protect the life you've worked so hard to build. Okay, but now let's zero in on a specific group, high-income earners. Because for them, the problem actually gets a lot more complicated, and the standard solutions, well, they just don't cut it. So here's the deal. For one, if you earn a lot, you probably have higher monthly bills, and you might be surprised to learn that savings often don't last as long as you'd think. But here's the real kicker. With traditional insurance, the more money you make, the smaller the percentage of your income they're willing to cover. It's backwards. This means people often have to juggle a bunch of different policies just to get close to the coverage they need. This is where these specialized high-limit policies become a total game changer. They're designed around this really powerful idea called own occupation coverage, and trust me, it makes all the difference. Now, the definition sounds a little technical, but it's actually super simple and incredibly important. It just means you're considered totally disabled if you can't do the main things required by your specific job. Not just any old job, but the one you've trained for and built your career around. And here it is. This is the magic phrase. This protection applies even if you are at work in another occupation. So, what does that actually look like in the real world? Let me give you the classic example because it just makes it so clear. Imagine a surgeon. Her hands are her whole career. She develops a tremor and can't operate anymore. With an own occupation policy, she is considered totally disabled as a surgeon. So she could go teach at a medical school, earn a whole new salary, and still collect her full disability benefit. It's protecting her specialized skill set. So that own occupation part is really the heart and soul of these policies. But to get the full picture, we got to quickly break down a few other key terms you're going to see. Okay, first up, how do you actually get paid? You've basically got two flavors. Monthly benefits are like a replacement paycheck. They provide that steady, predictable income. A lump sum benefit is different. It's one giant payment for a permanent career-ending disability. That gives you a ton of flexibility, but it also means you're the one who has to manage that money for the long haul. Next, you'll see something called the elimination period. The easiest way to think about this is like a deductible, but it's measured in time, not dollars. It's just the waiting period before your benefits start. And here's the key takeaway. A longer waiting period, say 180 days instead of 90, can make your premium a lot cheaper. And the flip side of that coin is the benefit period. This one's simple. It's the total amount of time the policy will pay you. It might be for a set number of years, or for the best policies, it could be all the way until you plan to retire. You can also add some cool upgrades or riders. Two of the most important are the residual rider, which is huge because a lot of disabilities just slow you down instead of stopping you completely. And the COLA, or cost of living adjustment, that one's vital because it makes sure your benefit keeps up with inflation over the years. And finally, there's this fantastic feature called a waiver of premium. It does exactly what it sounds like. If you're disabled and collecting benefits, the insurance company waives your premium payments. You don't have to pay for the policy anymore. It's literally a policy that pays for itself right when you need it most. So you see, when you put all these pieces together, it becomes crystal clear. Protecting your income isn't some luxury add-on. It is a fundamental cornerstone of any good financial plan. It's just as important as your retirement savings or your investment portfolio. Which brings us right back to the beginning, back to that very first question. Now that you've seen the real risks and the best solutions, I'll ask you again, is your most valuable asset, your ability to earn an income, really, truly, and properly insured? It's the one question we should all be able to answer with a confident yes.